Good morning. This is Joe Hoyle at the University of Richmond at Richmond, Virginia, and the author of your financial accounting textbook. In this chapter, we're looking at how companies take the financial information that they have kept and turn it into financial statements that they can send to outside decision makers. They often require outside expertise for this, but any of the work they can do themselves is very helpful. Now, in this second video, your uncle has come to you. As you will remember, your uncle and a couple of friends own an office supply store, and they are selling notepads and probably equipment and stuff to their customers, and they're keeping the financial information, but now at the end of the year, they need to produce financial statements. And they've done a good job probably in keeping the financial information, but they need that expertise to make sure that the financial statements that they release actually is presented fairly according to United States generally accepted accounting principles, what we term U.S. GAAP. And your uncle says, what should I look for that's going to have to be fixed? The process we use to take the information that the client produces and get everything according to generally accepted accounting principles is called adjusting entries. Now, adjusting entries will look just like journal entries, but a journal entry is made to report a transaction. An adjusting entry is reported because of the passage of time and sometimes to fix other errors. So if you have a sale, that's a journal entry. But if you have something that changes because time changes or because time passes, that's an adjusting entry. And your uncle wants to know what to watch for. One of the biggest adjusting entries that any company has is based on accrued expenses. Many expenses are incurred a little bit every day. For example, if you have a bank loan, the interest expense on that bank loan will get larger every day. If you have employees, they will make money every day, and you won't record that. It's just too much trouble. So when you get ready to produce financial statements, the accountant, either an outside expert or your own personal accountant, will look at all of the possible accrued expenses to see if any have grown that you have not properly recorded. And they will typically look at things like rent, like interest, like salaries, like utilities, because those grow very gradually over time. And the adjusting entries will bring it right ready for the production of financial statements. Journal entries are made when the transaction occurs. Adjusting entries are made when you're ready to produce financial statements. You also have some prepaid expenses. For example, insurance is almost always prepaid. So you pay for a coverage of a year. As time passes, as that months go by, that future value that's provided by the prepaid insurance becomes a past value, insurance expense. Now, you probably won't make a journal entry for that because it would be too much problem. The accountant will come in and say, we need to take some of this prepaid insurance and reclassify it as insurance expense. So accrued expenses, adjusting entry. Prepaid expenses, you'll need adjusting entries. Many companies will have accrued revenues. You'll do work for a customer, but the customer has not yet paid you, and you may not have recorded that. So when the accountant comes in, the accountant will say, have you done any work that you've not yet collected and that has not yet been recorded? Because that's an accrued revenue, and that needs to be recognized to make our financial statements fairly presented. And the adjusting entries will be made. Accrued expenses, prepaid expenses, accrued revenues. Adjusting entries are required. Finally, there are adjusting entries for unearned revenues. If you receive money before you do the work, if somebody pays you $7,000 before you do the work, that's an unearned revenue because the revenue cannot be recognized until the earning process is substantially completed. So until that time, it's a liability. You either owe the person the work or you owe them the money back. So when you collect money in advance, it's not recorded as revenue. It's recorded as a liability, unearned revenue. But then, over time, some of that revenue may become earned and needs to be taken from the unearned revenue account to revenues. So in this chapter, we talk a lot about adjusting entries. And that is anything that you need to update your financial information so that when the financial statements are prepared, they are presented fairly. So when your uncle talks to you, tell your uncle, okay, look for prepaid expenses, look for accrued expenses, look for accrued revenues, look for unearned revenues. If you have any of those, you're probably going to need adjusting entries so that the numbers that you present on your financial statements are proper or are fairly presented. This is the way that companies make sure that the information they convey to decision makers satisfy those decision makers' needs. Hi, this is Joe Hoyle, the University of Richmond. Have a great day.